Hello, and welcome to the MicroKeys Fiscal Fitness webinar series, part 2 of 4. Joining us today is CPA accounting consultant, author, and Get Payroll's CEO, Charles Reed. Charles, thank you so much for being our featured presenter for today's webinar. We're really fortunate to have you and help us to figure out the maze of accounting that we live in today. So just to set the tone, whole fiscal fitness series and webinar is, there's really a lot to fiscal fitness in general. And I learn a lot about that every day, just running our own business. But for the purposes in this series, this is what we consider fiscal fitness: knowledge of what makes your business tick and accounting measures in place to track these elements. A process to continuously improve the productivity and efficiency of your operations and back office management to increase scalability. So we want to always be checking those processes and make sure that they're productive and efficient. We're going to focus on planning and processing for predictable growth in the future. And of course, my signature addition to the fiscal fitness is creating a company culture that encourages the full engagement, productivity, and talents of all of your employees. So MicroKey's role in your fiscal fitness, we provide you the best software tools and support that you can leverage to improve the efficiency and productivity of your business. So you're all using our solution, and within that solution are gems of features that really and truly help to improve your productivity of your business. We also want to take a key role in providing information to each of you as individual leaders, people that work in the accounting area, as business owners, that's going to be specific to your business and help you to help your business achieve fiscal fitness. So the journey that we have planned for you, the fiscal fitness journey we have planned for you, is a series of educational pieces that are already recorded, and several more are coming your way to help all of us in all of these aspects. So depending on how you like to learn and what your schedule is, we have 2 more fiscal fitness webinars planned that are going to be live, like this one, October 6th, and then we have another one November 10th. Both are going to be facilitated at 2 p.m. Eastern Time. We also have 3 podcasts with our MicroKey on air dedicated specifically to the fiscal fitness, and they're already published, and at least one more is on the way to you. Our podcast, you can find it on Apple, Google Podcasts, Spotify. Type in the search MicroKey on air. You're going to see a really nice pink neon microphone that indicates that it's us, and listen away. There's some really good gems, really fantastic guests that are all business centric to give you tips and tricks and different things to consider as you're navigating your fiscal fitness or just your business in general. Last but not least, we are offering, I don't know if you guys have ever visited microkey.com, but we have a set of blog posts that I've written that really focus and bring all of this information together for you. They're typically structured in a 5-minute read. It wouldn't take you more than that to get through the information. So please go ahead and check out microkey.com. Under the company menu, there's going to be a little menu that says company. Select blog, and that is going to bring to life your business to the different fiscal fitness concepts discussed in the webinars and in the podcasts. We really hope that you benefit from these and you'll join us on this journey to your fiscal fitness. So now that I've set the stage, why I thought it was important for us to bring this fiscal fitness concept to you, our MicroKey user, I would like to introduce Charles again. He's going to shed some light on some of the wisest fiscal decisions you can make as a business leader or an owner, with impressive education, analysis, and consulting experience in all aspects of accounting. Get your notepad ready to jot down some of the best tips you never knew you needed. Charles, thanks again for being with us. Go ahead and take it away.
Thank you, Victoria. It's my pleasure to be here and to assist you with providing information to MicroKey Solutions people and users and interested parties. I've been in the payroll business for a number of years, and I'm going to present a lot of things having to do with payroll, most of which are in my newest book, the Payroll Book, A Guide for Small Business and Startups, which at the end I will provide all the listeners an ability to get free of charge. So let's just get to it. Michael, there we go. The pros and cons of selecting business entities. What entity is really right for you? If you've already chosen it, well, you have. If you haven't, or if you're thinking of changing, there are some things to be considered in different entity selections for payroll purposes. Four most common ones start out with the corporation. The corporation is an entity of the state, so you would set it up with your local state government, and you would incorporate as a separate entity apart from you as an individual. The important thing about this is it limits your personal liability. The corporation is liable for its actions and its debts, and you and your personal assets are not subject to that liability. That's extremely important. Now, in the corporation, there are two ways to be taxed: as a C Corp or as an S Corp. And the S Corp is a section of the tax law which deals with creating a corporation that is for tax purposes, a pass-through entity. What you do at the state will be the same regardless. This is only a selection for the Internal Revenue Service and taxability. An S corporation is a pass-through entity. In other words, the profits or loss of an S corporation pass through to the shareholders and are taxed at the individual level. A C Corp is taxed as an entity itself and pays taxes on its profits or losses, and then the distributions or dividends it makes to its shareholders are then taxed as well at the personal level. So for most small businesses, a C corporation is a less desirable entry. An S corporation is much more desirable in that you only get taxed on the profits once. There's some tricky things about deductions and so on, but your CPA or tax preparer can explain those to you as that corporation tax return is done. And that's one of the downsides of a corporation, is you have an additional tax return to file and additional filings with the state. The next major entity is a partnership. A partnership is less desirable from a tax point of view and from a liability point of view. Normally, a small business partnership, everyone is a general partner and everyone is personally liable for all the debts of the partnership. That can be a real problem if things happen that you don't expect. Partnership is also a pass-through entity where the profits or losses are taxed at the individual level. Going beyond that, you have the LLC, which is a limited liability company. It has a lot of the same advantages of a corporation in terms of limiting the liability, better production, and so on. One of the advantages of an LLC as opposed to a corporation is disparate distributions. In a corporation, if you make a distribution to the shareholders, it has to be equal based on their ownership. If they both own 50%, then they both get the same distribution. In an LLC, you have the ability to design in the formation documents a disparate distribution. In other words, if you have someone that's put in all the capital and wants that back first, you can specify that the distributions go to that first and then go equally or in a different format. That's one of the main advantages of an LLC. The disadvantages are like a corporation, obviously additional tax returns and so on. Now, one of the things you can do with an LLC is treat it as a disregarded entity if it's only you. And so you don't report it, it just appears on your 1040 and as a Schedule C, but you still retain the liability protection. Now, the other entity is a sole proprietor. This requires nothing. In most cases, you don't even need to get a license. You just set up a business and say, I'm in business. The downside, of course, is you're personally liable for everything that goes on. And it doesn't relieve you from having to file employment taxes if you hire people or any of those things. So it is very disadvantaged from a liability point of view, and it doesn't offer some of the tax benefits that a corporation or LLC might offer. Okay, moving on. Employers versus independent contractors. This is a very contentious issue. It's one that a lot of attention is brought to, and more as the gig economy grows and more people become independent contractors. We've all seen the controversy with Uber and Lyft, whether their drivers are employees or independent contractors. We're seeing that with the trucking companies, whether their drivers are employees or independent contractors. California has passed a number of laws, some of which have been partially overturned, some of which are causing great consternation at this very moment with truckers at ports of entry in Oakland and other places. And so it's confusing. There is a body of history, and there are 20 common law rules that determine whether a person is a independent contractor or an employee. And it's a preponderance of those rules that control. It has to do with who pays them, whether they have the risk of loss, whether they can hire someone else to do the job themselves, all the length of the relationship. Is it full-time? Is it part-time? Do the independent contractors advertise and take on multiple clients? So it's something that you need to look at if you have a question, but in reality, it comes down to what the judge decides if there's a disagreement. The United States Labor Department estimates that 70% of all U.S. businesses misclassify workers, either as employee or independent contractor, or as hourly versus salary, we'll get into later. It can be very expensive if you misclassify people. I've seen clients get penalized into 5 figures for misclassification of employees versus independent contractors. It also is something that small businesses and startups tend to do. They just want to pay everybody with a check and a gross pay and not withhold anything and not pay any employment taxes. That makes life easy at the moment, but if those people are really employees, when you get audited, it's going to be a nightmare. So you need to make sure that who you hire and how you hire them, if you have questions, consult with your CPA, consult with an employment tax expert, possibly an employee law attorney. Make sure you get it right. It's very expensive not to. Moving on, are family members employees? They can or they can't be. It depends on the entity, the employee, their age, what they do, and so on. Wages you pay to a child are subject to income tax withholding, as well as Social Security and Medicare and food taxes, federal unemployment taxes, if they work for your corporation, your partnership, or an estate. Your spouse may or may not be an employee. Again, in a corporation, if your spouse is a shareholder as well, they may well be an employee, as will you be. If you're a corporate owner and you work in the business, you are an employee and need to withhold, deposit, and pay the taxes and do all the filings, W-2s, 941s, and so on. Now, there's another classification that we don't see as often, and that's statutory employees and statutory non-employees. Statutory employees would be independent contractors normally, but Congress has deemed that they're employees. That consists of agent drivers or commission drivers, full-time life insurance salespersons, home workers, and traveling or city salespersons. Statutory non-employees are people who would normally be employees, but the government has decided they're not employees. And that's going to be qualified real estate agents and direct sellers. Again, if you have any of these people, check with your CPA or your payroll company. Volunteers may not be employees, but you've got to be careful that they are truly volunteers and that they're not doing work that would otherwise be an employee's work. So you've got to be careful. They can do things like driving, helping with a blood drive, mentoring underserved populations, acting as counselors, scoutmasters, and so on. But don't push it too far or you're going to get into trouble. Interns are normally going to be employees. You very seldom can get away with calling an intern an unpaid worker. One final category is religious workers, and if you have that, please check with your CPA. What is salary? Salary is a set sum you pay an employee on a weekly, biweekly, monthly basis. Whether they're there or not, you pay them a specific amount. Can you not pay them if they don't show up? If they don't show up for the whole day, you can. If your employee handbook says so, you can deduct that day's payroll. But if they show up for an hour, you got to pay them for the day. Now, it can be salary. This comes down to what's referred to as FLSA, Fair Labor Standards Act. And it defines who's subject to overtime and who's not. And basically, hourly employees are going to be subject to overtime rules, which says under federal law, if they work more than 40 hours in a work week, which we'll get to later, then you have to pay them overtime if they work more than that 40 hours. If they are exempt from overtime rules, then you can pay them salary. And exemptions are varied. You can have an exemption for an executive, for an administrative person, and that is personnel who qualify with a salary and have education and administrative duties beyond what a normal employee would have. A professional exemption, CPAs, doctors, lawyers, so on. Computer people, provided they make a substantial amount of money, may be well exempt. Again, check with your CPA if you have that. Highly compensated employees, employees making more at the time the book was published of $107,000 a year, are not subject to overtime. So those are the people who are exempt from overtime rules, which means you can pay them salary and not have to worry about paying overtime. Let's talk about deductions. Deductions are things that are removed from payroll. This would be voluntary and involuntary garnishments. Involuntary garnishments are those that are issued by the court. They're not in every state. For instance, in Texas, there are no involuntary garnishments other than taxes. And voluntary ones are where a person authorizes their employer to deduct and pay a debt to a third party. It could be for savings bonds. It could be to go to their credit union as well. It doesn't have to be a debt. These are normally after taxes and they come out of net pay. Other deductions may include union dues, charitable deductions, and other things of that sort. Involuntary deductions will, of course, be garnishments, tax levies, which could be federal and or state. And if you receive a garnishment for an employee, you have to withhold that money and forward it based on the legal document. Even if the employee says to you, I really don't owe this, you don't have a choice as the employer. You're going to have to withhold and remit that money as the legal document, the court document tells you to do. One of the big deductions is child support. You hire a new employee, you submit their information under the new hire regulations in every state. This goes to a national database, and if that person is in that database owing child support and there's an outstanding child support order, you will be notified and you will get a copy of the order telling you how much you have to withhold from that employee and what you have to do with it. In many states now, you also have to withhold child support from 1099 independent contractors. This didn't used to be true, but it's becoming more and more common in states. And there is a list of them at the Labor Department that lists every state where that is part of the law. So when you have a child support deduction, you'll have to calculate the net pay and then take that child support out of the net pay and forward it to basically the state attorney general's office in whatever state that the child support order was issued. If there's multiple orders, there's rules for what the priority is. There's rules for how it has to be remitted. You can't fire an employee because they have a child support order. That's illegal as well. In many cases, you can take a small fee for doing the work of calculating and remitting the child support withholding if you so choose. Most of our clients, because I run a service bureau, don't insist on that. They just feel that the employee has had enough of a loss already with the child support. And that can be, it can be up to 50% of their net income. There's also bankruptcy orders, federal agency debt collection, such as student loans. These are all subject to limits, and you need to be aware of those and understand what the responsibilities are and what you can and can't take out. All right, let's talk about taxes. You have employee taxes and you have employer taxes. The employee taxes consist of the withholding for income tax and the employee portion of FICA and Medicare, Social Security and Medicare. FICA is FICA, stands for the Federal Insurance Contribution Act. It's either FICA or Social Security as you wish. You're required to withhold that from an employee, but not from an independent contractor, which is where the government really gets into it because they want the taxes. That has to be withheld from each check and remitted to the federal government based on how much you actually are collecting. It can be annual, it can be quarterly, it can be monthly, it can be semi-weekly, it can be next day, depending upon how much you withhold from your employees. The employer taxes consist of the employer share of FICA and Medicare, which is equal to the employee portion, plus FUTA taxes, which is the Federal Unemployment Tax Act, and that's the federal unemployment. On top of the federal, you have state. Most states have state withholding for income tax purposes, where you have to withhold from the employee and remit that to the state, normally monthly, sometimes quarterly. You also have in every state, state unemployment. That is an employer tax, and you pay that directly, normally quarterly, to the state. Now, if you don't make the deposits, if you don't file the forms, there are penalties. The penalties normally come from arithmetic errors. You haven't calculated things properly on the forms. That's the most common error that causes a penalty. And if you've underpaid because of that miscalculation, then there will be interest as well as penalties for the amount that was due. So you have miscalculations, you have failure to submit the forms, you have failure to submit the forms timely. Either one of those will cause penalties. You have the failure to deposit the appropriate taxes that you withheld or owe, or you deposit them late. Either of those will generate penalties. Now, if you make a simple mistake, the Internal Revenue Service cannot penalize you. They can only penalize you for gross negligence. However, the IRS determines whether it's gross negligence or simple error. You can fight that presumption by the IRS by appealing any penalty, and there's a whole series of appeals you can work with through the IRS up to and including federal court. My suggestion is that you always appeal them, and you appeal them to multiple levels. The first time you send a letter, to the IRS about a penalty that they have imposed, your request for abatement will be denied 100% of the time. On the second request, which goes to a different level, sometimes, occasionally, you'll get an abatement. The third level, you'll get more abatements. The fourth, fifth, and sixth levels, you will get more abatements. If, in fact, you end up going to tax court, 95% of all U.S. tax court cases are settled pre-court. They want to settle. So my recommendation is to appeal and appeal and appeal and appeal. It's a whole series of no's followed by a single yes. So you want to just continue to appeal those. Now, there are also the same types of things with the states. Again, miscalculations, not depositing on time, not depositing, not filing on time, not filing. You will have the same situation with the states that you do with the federal government. Okay, payroll. Let's talk about a few things here. What is a work week? A work week is a mandated term under the FLSA, Fair Labor Standards Act. A work week is 168 continuous hours. That's 7 days, 24 hours a day. That's a work week. That's what's used to calculate whether they worked more than 40 hours within that work week for overtime purposes. When does that work week run? It can run at your choice. You can make it from noon on Wednesday to noon on Wednesday. You can make it from Sunday at midnight to Sunday at midnight. To pick that work week based on your particular needs. Now, can you change it? Yes, you can change it. You can't change it to avoid paying overtime. But if there's a reason that you need to change the work week, you're allowed to do so. That's your choice. Pay period. Pay period is the period which you calculate payroll over. That may be daily, it could be hourly, could be weekly, could be semi-monthly, twice a month. It could be every 2 weeks. It could be once a month. Now, under FLSA, you probably can't pay less pay periods than once a month. A few exceptions, but it's with a regular employee, it's very unlikely. So you have to pay at least monthly. So you have to have a pay period of at least monthly. You change that pay period, of course. Again, you can't do it to avoid paying overtime. We recommend every 2 weeks. Lots of times we set up clients where the pay period ends on a Friday and the payday, which we'll get to next, is a Friday a week later. But payday doesn't determine overtime. If you're paying biweekly and the person works 60 hours in that pay period over 2 weeks, do you have to pay overtime? You have to go back to the work weeks. That 2 week period for your pay period has 2 full work weeks in it. And if they worked more than 40 hours in one of those work weeks, they get paid overtime for that, even if they were paid for less than 40 hours in the other one and less than 80 hours in total. You don't get to determine overtime except on a work week basis. That's FLSA. Today is the day you pay people. Again, that's your choice. You can normally go up to about 10 days after the end of the pay period. You can't go 30, and it varies by state because the states have rules. If their rules are more restrictive than the federal rules, you have to abide by the more restrictive rules. If your state rules are less restrictive than the federal rules, you are basically stuck with the federal rules. Rules only apply if you are in interstate commerce, but for all practical purposes, we're all in interstate commerce. If you think you're not, you're a small business, operates solely within the state, talk to your CPA. You may be able to work with less restrictive state rules, but it can be a stretch. Moving on, the law. There are federal laws, state laws, local laws. There are state minimum wage rules. There are federal minimum wage rules. Federal minimum wage currently is $7.25 an hour. The state ones and the local ones vary all over the place, going up to in excess of $15 an hour. You need to be aware in your state and your locality what the minimum wage rules are, and your CPA or your payroll company can help you with all that. There are federal child labor laws. Depending on the age of the person you employ, if they're under 18, you may be subject to rules, what they can and can't do, how long they can work, how much they can work during school year. If the rules are different for agriculture than they are for non-agricultural. That goes back to the family farm issue. There's child labor laws. There are youth minimum wage rules, which is $4.25 an hour as opposed to $7.25, but they have to be under 20 years of age. It has to be doing their first 90 consecutive calendar days of employment. Again, if you have that situation, check with your CPA or your payroll company. There's all kinds of labor laws at the state and the federal level. Again, if you think you're going to run into any of those, check with your CPA or your employment tax attorney. One of the big ones that's come out in the last few years was FMLA, Family Medical Leave Act. This is where you have to pay people if they take time off for certain things such as adoption, illness, taking care of a loved one, taking care of a child, and so on and so forth. If you employ more than 50 full-time equivalent people, you are subject to this. Again, your CPA can help you with that in the detail. One for small businesses is 45S, which a lot of people don't realize. If you pay people time off for FMLA purposes, but aren't subject to FMLA because you're less than 50 full-time equivalent employees, you can pay them for time off. If they take a day off sick, if they take a day off to take care of a child, and you pay them for that as part of their paid time off, you can get a tax credit for up to 25% of that payroll. That's just free money. So you need to have a policy in effect in your employee handbook about this, and then track their time off for FMLA type purposes. And if they take it off for that, you can file and get a tax deduction, a tax credit on your income tax return, whether it be your corporate return or your personal return if you're a sole proprietor, for up to 25% of the wages. There's some details on it. Again, talk to your payroll company or your CPA, but be aware of it and ask about it because it's free money. The Affordable Care Act, we're all aware of Obamacare and how it can affect us. You just need to be careful of the rules. Reporting, which I spoke of earlier, you're required to report every new hire to the state. And if you don't, and they do have a child support order outstanding, you may find yourself having to pay the child support that you should have withheld to the state where it's due, regardless. So be aware of that. Make sure you report everybody that you need to for new hire reporting. Labor posters. The Department of Labor and many states require that you post mandatory labor law posters in a prominent area within the workplace. You can get these all from the Department of Labor free and from your state labor department free, or you can buy them from a service for a few dollars a month and they will update them as necessary. Now, just for your information, in the 30 plus years I've been in the payroll business, I have never seen a poster audit. I have never seen a penalty for not having labor law posters posted in the workplace. The law exists, but I've never seen it enforced. If you're in contracting, in construction, you work on federal projects, you need to worry about Davis-Bacon and Walsh-Healy Acts, which talk about prevailing wage, which basically means union wage, and you have to pay that. Again, check with your CPA or your payroll company. The Equal Pay Act. Equal Pay Act requires equal pay for equal work. There's a lot of discussion about gender disparity in payroll where women are paid less than men. A great deal of the disparity is due to a lot of things, but in your business, if you have two people doing the same job, you got to pay them the same. Now, you pay somebody who has more experience, has been with you longer. Can you pay them differently? Yes, but you have to have the justification. Determining equal work and what equal pay means is a very complex thing. You probably won't run into it as a small business, but if you're a major corporation, you obviously will. Okay, miscellaneous items. Okay, there's a lot of things that are involved in payroll that you may not think about. And just to touch on a few of them, there's all kinds of record keeping requirements from all kinds of agencies. Again, they're detailed in the book, whether it be the Department of Labor, the Internal Revenue Service, for Family Medical Leave Act, Civil Rights Act, age discrimination, immigration, direct deposit and payroll records, employee handbook records, medical insurance records and signups. One of the things we saw years ago was an employee who didn't take the group insurance and then sued because his wife had a disabled child, and won because the company couldn't prove he had turned down the insurance. So record keeping can be critical. Workers' compensation. Workers' compensation is required in 49 states. It's not required in Texas. And you have to have it, and you have to carry it, and you have to keep track of it. So be aware of that. There's a lot of security and internal controls issues you need to be aware of for payroll, so there's not payroll fraud, whether it be the people doing the payroll or the employees defrauding you. I saw an instance in a bank we were consulting with, and the employees were deliberately miscalculating overtime. And this to their attention, they made sure that my consulting assignment was terminated because they didn't want me telling their bosses that they were cheating the company the way they were calculating overtime. So there's a lot of things go on in this. Obviously, you need to be aware of hiring people who aren't qualified to work in the United States. The fact that they have a visa doesn't necessarily mean they're entitled to work. The I-9 is the form that you use when you hire someone to determine whether they are legally able to work in the U.S. and you're legally able to pay them. Be aware of it. Some of the visas get strange, and you need to be aware of them because they can also control whether that person is subject to Social Security or not. So if you have people who are not citizens, be careful. Other issues may include such things as what's a PEO, which is a professional employee organization, where they take responsibilities for paying people. They tend to be very expensive. Human resource management is cheat. This is one that catches some very sophisticated operations. If you pay people and they don't cash that check, they may not be able to keep that money. You may have to turn it over to the state. Every state has its cheat laws. It may be if it's under $50, you don't have to report it. But in most states, unclaimed payroll checks, uncashed payroll checks have to be remitted to the state. That money you have to send to the state normally annually. They keep it. And that's where you see these lists of unclaimed money that you see people advertising. It's also published in a lot of newspapers where people can go check with the state to see, based on their Social Security number, if there's money out there that belongs to them. Some of that is unclaimed payroll checks. There are federal laws based on the number of employees. So the more employees you have, the more laws you're subject to. You need to be aware of those. And last thing I'd like to discuss is employee handbooks. An employee handbook is a necessary thing and will control a lot of what we've talked about. All the things we've talked about should be laid out in the employee handbook. What's your work week? What's your pay period? What's your pay date? What's your criteria for being exempt? Salary, how child support's handled, how deductions are handled, how you pay people, when you pay people, are you paying them via check, direct deposit, on and on and on. Time off, other deductions, other things that crop up in payroll should all be in your handbook, and people should sign off on that they've read it and understand it, and you need to keep that because that basically is your contract with your employees. So I'm going to turn this back over to Victoria. Victoria, it's all yours.
Thank you so much for that really valuable information. Truly do appreciate all of those nuggets.
One final thing, Victoria, as I promised them in the beginning, if they'd like a copy of the book for your listeners, if they will go to thepayrollbook.com, enter the discount code podcast is what I normally use. But for your listeners, if they will enter that discount code at thepayrollbook.com, we will ship them free of charge a copy of the payroll book, a guide for small businesses and startups. No shipping, no handling. We will just ship it to them free.
Awesome. Awesome. That is extremely generous. There is tons of experience and examples. So really awesome. Thank you so much for extending that offer to our listeners. Guys, get a copy of the book, take a look at it, get your questions, contact your accountant and see what stuff that you're missing that you could be eligible for. So don't forget to tune into our first 3 fiscal fitness podcasts that are streaming now. There's one with David Walters, and there's another one with Charles Reed. David covers step by step on driving growth and productivity of your business. Take a listen. Thanks, everyone. Have an amazing day.